Hey folks, welcome to a brand new edition of Smart Money, your favorite weekend show. This week we have a very interesting topic that we're going to talk about: how to invest directly in the overseas markets, specifically in the US markets. Now with the Nasdaq, the S&P 500 all at record highs, tech stocks doing so well, that's the question on our minds. What is the taxation angle? What is the currency angle? And why should you invest in US markets when there are so many good stocks to invest here in our own markets? All of those questions will be answered in the next half an hour. Our experts today, Vikram Shah, the co-founder and CEO of Vested Finance, and Prableen Bajpai, the founder of FinFix Research and Analytics, join us. Vikram Shah's Vested Finance is an investment platform enabling Indian investors to invest directly in the US stock markets. In fact, Vikram was previously an investment banker himself at JP Morgan, and he's also worked with 3 different startups in the fintech, AI as well as analytics space. So it would be very interesting to chat with him. Our other guest, Prableen Bajpai's firm FinFix, is an all-woman financial research and wealth management firm. Prableen, in fact, has over 10 years of experience as a finance expert herself, and her work has appeared regularly on credible platforms such as Nasdaq, The Street, Seeking Alpha, etc. So, ladies and gentlemen, thank you so much for joining me on the show. Vikram, I want to start with you, right? Since you have a platform that helps investors invest directly into the US markets, first tell us not how, but why should I invest in the US markets or in global markets?
Yeah. So in terms of investing internationally, there are a lot of different reasons that one could look at diversifying their portfolio internationally. But the few important ones that every investor should take into consideration, first and foremost, is just adding this additional pillar of geographic diversification to their portfolio. So in terms of our portfolios in India, we actually do a good job in terms of diversifying it by asset base. So we invest into different kinds of assets such as gold, real estate, equities. What we also do is we diversify time base. So we don't invest all our money in one go. So we invest in SIPs, which invest in the market at different points in time. And then we also diversify our industry. So we don't invest all our money into, let's say, pharma or banking or IT services. But what's really been missing in a lot of our portfolios has been this pillar of geographic diversification, where all our money is actually allocated in one market itself, in one country itself. And if you look at the international markets, about 20 to 30% of a retail investor's portfolio in the US and the UK is typically invested outside of their local markets. And so that's one key reason why somebody should look at geographic diversification or investing in the US markets. The other is that as Indians, we're consumers of global brands on a daily basis. We use a lot of these brands, so we are familiar with their businesses, their business models. And so then why not invest in some of these and build our wealth while we consume them as well, right? So of course, the famous tech companies, Apples, Googles, Facebooks of the world are part of this. But then there are also a lot of consumer companies, right? There's Nike, there's Starbucks. All of these are listed in the international markets, and one can invest in them directly. The third and a very interesting one is that there are a lot of themes that are now emerging, right? In today's world, there's the theme of artificial intelligence, there's the theme of blockchain or cryptocurrency, there's CRISPR in healthcare. A lot of these companies that are working on these themes are actually available to invest in the international markets, specifically the US markets. And so what you can do is play on these themes that are really going to be the future and invest in these companies when they're small currently and are building towards the future.
Okay, so all of this, sure, all of this sounds very exciting. I mean, you spoke about 3 reasons why one should invest abroad, right? One, of course, is diversification away from your local market. 2 is you use a lot of these products, right? Apple, Facebook, why not invest in the companies? And of course, you spoke about these key themes like AI, etc. But I want to get Prableen into the discussion, and I'll come back to you, Vikram. Prableen, what are the different routes to invest abroad? I do know that you can go through the mutual fund route, active, passive, but you tell us, as an investor, what are the different routes to look at?
Right. Thanks, Sonia, for having me on the show. So primarily, there are 2 routes. The first is, through opening a brokerage account abroad, and the second is via mutual funds. And within the first one, where we can open a brokerage account, there are 3 methods to do it. The first one is through a tie-up with a domestic brokerage house. For example, Kotak Securities has a tie-up with Interactive Brokers abroad. Or HDFC Securities, they route the investments abroad through Scotcal, which is, having a tie-up with Drive Wealth, which is a brokerage company abroad. That's the first thing, where you can tie up with your Indian brokerage house and then they take you to the US markets or markets abroad to a brokerage house. The second one, Sonia, is through companies like Vikram owns, which is vested. Basically, these are platforms, some of which can be, registered with the Securities Exchange Commission in the US as an advisor. Some of them are not. There are a few other names like Winvesta, Globalize, IND Money. All of them are not brokers directly, but they are platforms which have tie-ups with, again, a brokerage firm in the US through which your investments can be routed. And majority of these have Dry Wealth as their broker in the US. And then the third one, Sonia, is as an individual, as an Indian investor, I can directly open a brokerage account abroad with a couple of companies. Few names are Trade, Interactive Brokers, and Charles Schwab. They allow Indian investors to directly open a trading account with them.
Okay.
The broader SOP to open an account with any of them is almost the same, because the broader guidelines will be the same, but there are, of course, nuances which vary across each of these methods. And all of these, the money routed abroad is under LRS, which is the Liberalized Remittance Scheme by the RBI.
Okay, that's important, So I want to know what exactly is LRS? How do you open an account? What is the taxation involved? What about currency, right? So many questions. But Vikram, let me come to you. So I haven't, by saying I'm giving you an example of a regular investor has not invested yet abroad. How do I go about it? What are the things I should think about while building my portfolio?
Yeah. So in terms of building your portfolio, you would want to keep it very simple, right? You want to take advantage of a lot of funds like you do in mutual fund investing here in India. There are a lot of ETFs available in the US markets that you can start off with. Of course, if you know particular companies that you anyway want to invest in, then you can invest directly in the stocks. However, ETFs are the best way for somebody to get started. The process is very simple. You basically go online, open a brokerage account. It's completely online. It's in fact, it can be opened now. Accounts can be opened now in 30 seconds on a platform like ours. Then the fund transfer is what you do under the LRS. So you can do $2.5 lakh every year in terms of remittances under the LRS, and investment is something that's allowed under that. And once the money is in, you can basically hold it as cash. So it's kind of like a wallet. You can buy, sell, the money still stays in dollars. And then whenever you want to bring it back, you put in a withdrawal request and the money comes back in rupees in your local bank account.
Okay. What about currency? Because, now with the rupee at a multi-month low, how does the currency work, Vikram? Are there any advantages? What are the advantages and disadvantages as far as the currency is concerned?
Yeah, the way we see it, it's always been an advantage historically to hold some dollars, because the rupee traditionally has depreciated. So if you look at the value of $1, it was 45 rupees about 10 years ago, and now it's close to 74, 75, right? So on a yearly basis, we see that the rupee loses about 3 to 4% in value. And that is something that actually adds to your returns if you're investing internationally in dollars. So from a currency standpoint, while in the short term, it might be a risk if you try to time it, but in the long term, it actually adds to one's portfolio returns.
Okay, so that's another added advantage why you perhaps should invest abroad and at least diversify, right? You can make use of that rupee fall. Prableen, what about you? As an Indian investor, how does currency play a part? Do you think this is a good time to be investing abroad purely because of how much the rupee has fallen?
In the last 10 years, Sonia, rupee has depreciated by 65%. And other than exports, I think investing abroad is the only thing from where, we benefit if the rupee is depreciating. So, that cannot be the only reason to invest abroad, but that is definitely an added advantage. And, I'll just give you some figures here. If we look at the NASDAQ returns in 2020, it was about 48%. But when we see the same returns in rupee terms, it works out to be about 53%. So in majority of the cases from 2011 to 2020, other than 2017, rupee has, the depreciation has actually worked in favor, because there can be times when the rupee appreciates as well. And that can do the reverse to an investor's portfolio. Let's say somebody is going to redeem money and there is some appreciation in the rupee, then obviously there will be a little damage there done to the portfolio returns. But overall, broadly, what we've seen that, the rupee has continued to depreciate against the USD. So that is, of course, an advantage. But there's a lot of currency conversion, like Vikram mentioned, that though it's easy to open an account, but whether you open an account with a company like Vested, a platform, some other platform, Sonia, or through a brokerage account in India, or directly, you have to do a wire transfer for the amount that you want to invest directly to the brokerage firm in the US. And there are a lot of costs involved in currency conversions, because the banks always have a bid spread in terms of the price that they offer when you're buying and selling dollars. There are bank remittance charges. There is a conversion fee into a USD. There is a GST on that. And from the 1st of October 2020, now there is also a tax, which is collected at source, a 5% tax above remittance of 7 lakhs, basically. So a lot of these aspects must be, understood and well understood before any investor is investing directly abroad.
Okay, those are a lot of costs, right? Vikram, does this become a very costly exercise then to invest abroad if you end up paying GST, bank remittance charges, conversion charges, and tax at source? I mean, I'm better off than just investing in my own country, right?
Yeah, so in fact, when we started off, it was a much costlier process. Like there used to be commission fees also per trade that you would have had to pay about $5 to $10, and literally it made no sense for you to do it then. However, now we brought it down to zero commission, and so on buying and selling, you don't pay any costs. Now the only two costs that are remaining are the money movement costs, and those are also things that are coming down. So as we work with the banks, basically we are working with them to reduce the fees to ensure that it becomes much more viable. So right now, there is a fixed sort of outward remittance fee, and then a fee when you bring the money back. So it's not advisable for somebody with small amounts to start investing internationally. However, we're working with a banking partner to reduce that so that it becomes much more accessible for every kind of investor.
Okay, this has been really, really helpful so far. I've understood a lot about investing abroad and, the pros as well as the cons. But don't go anywhere, folks. We're going to come back in just a moment from now. Lots more queries coming in as well. So we're going to try and answer some of them in just a bit. Welcome back. Thanks for staying with us on Smart Money. We're having a very interesting discussion on the pros and cons of investing abroad directly. So we've had, of course, two subject experts joining us. Vikram Shah, who's the co-founder and CEO of Vested Finance, and Prableen Bajpai, the founder of FinFix Research. And so far, we've discussed everything about what the pros and cons are. But the bigger question is tax. Now, how much tax do I need to pay on the gains that I make after investing abroad? Is it much higher through direct investing abroad? All of these questions answered. Prableen, first to you. On the taxation bit, what's your advice?
Okay. Sonia, before coming to the taxation, I'd also like to highlight a bit of the compliance issue which are involved. The number one being that, every time a remittance is done, the Indian investor has to fill a form, which is the A2, which is, a declaration basically that remittance is being made abroad under LRS. Second, that a form which is called W8BEN has to be uploaded. A lot of platforms, especially when you're investing directly through a brokerage account abroad, require that because there can be some withholding tax. So these are some of the forms which need to be filled, compliance issues, and even in your own ITR as an Indian investor, you have to show your foreign assets. Other than that, coming to the taxation part, Sonia, if you're holding regular shares and you make any gains on it, there is no tax, which is deducted in the US, and you can just get your money back in your Indian account. And when you file your taxes, if your investment was held for less than 2 years, that is 24 months, then you pay tax as per your tax slab. And if you held the investment for 2 years, then you are eligible for indexation, just the way we do for debt funds. Debt funds we consider for 3 years, here it's for 2 years. But for any dividends which are earned on the stocks which are held by the investors, there is a TDS which is deducted, which is 25%. So let's say a $100 dividend is earned overall. So $25 will be held back by the US entity. And they would give you a separate form later, which is, I think, 1042S, wherein, because there's a double taxation treaty with the US, wherein you can say that this amount of tax has already been paid in the US, and then only the remaining part is paid in India.
Okay, so there's a 25% TDS that you have to pay on the dividend income that you earn. In fact, we're getting a query as well on this. A gentleman has written to us, Siddharth writes to us on Twitter, and he says, what happens on a bonus, a stock split and a dividend? Also, how do we receive that money and what are the applicable limits? Since Prableen answered part of that question, Vikram, I want to come to you on this whole issue of taxation, and just to answer our viewer's query, what would your view be?
Yeah, so just, starting one from the compliance point, and Prableen mentions a very good point. What we've now been able to do with technology is automate all of that. So if you're investing internationally through a platform like Vested, basically, you don't need to do any kind of paperwork, which is, of course, the advantage of technology. And that advantage extends to the taxation world, where what we've done is we provide all of the information you would need in rupees, convert it into rupees as per income tax regulations at the end of the fiscal year, so that you can easily file your taxes even though you're investing internationally. So that's essentially what happens in terms of taxation, and we trying to help people out. In terms of the question that Siddharth raised, so stock splits, and I mean, they work the same way. So stock splits or any kind of bonus, you would get them directly in your brokerage account. And the same is with dividends. So it gets credited as dollars into your brokerage account directly, and the 25% gets cut, which you can take credit for when you're filing your taxes in India.
Okay, got that. So far, just to put down all the advantages of, investing abroad, there is this whole diversification angle. There is the currency angle, right? The rupee is at a 6-month low, so perhaps this is a good time to be investing abroad. There is, of course, you're investing in companies that you use on a daily basis, Apple, Facebook, all of that. And there is entry into new themes like AI, analytics that he was talking about, big data. But what are the disadvantages? Prableen, coming to you, if you had to put out some red flags of investing abroad, what would they be?
Right. Sonia, so there has been so much interest in the US markets also because in the last 2 years, we've seen indices such as NASDAQ give about 37 and 47% returns. And even if we all deny that we are not looking at returns and we are looking at benefits beyond returns, somewhere majority of the investments at this point are, driven by the returns that we are seeing. So I think just a word of caution, ultimately it's equities. Your time frame must be long when you're investing abroad. Go in a staggered manner, and you can't expect super phenomenal returns going on all the time. Markets, they give returns in the winners keep rotating, so there can be a time when Indian markets actually outperform the US markets, and then US markets outperform the Indian markets, like it has happened in the last couple of years. So I think just a word of caution that just looking at returns, that should not be the reason to invest. But yes, beyond that, I think these are very compelling reasons. Diversification, and also the low correlation, Sonia, that the Indian markets have with the US markets. If you look at the MSCI data from 2009 January till about 2020 December, the correlation is as low as 0.16, and correlation moves from -1 to +1. So though it's not a negative correlation, but I think 0.16 is still a very good low correlation. And you are definitely insulated by any kind of domestic currency and country risks, such as elections or something happening on the borders. So geographical diversification, I think, is a must for everybody. How much that depends on an individual's portfolio. And if somebody is looking at direct investing, all the compliance issue, currency conversion issues, documentation and compliance must also be kept in mind, especially as the amount increases that you're looking for.
That's a very important point that you made about the low correlation that India has to the US. So basically, you're hedging yourself, right? If part of your portfolio is invested in the US markets, fair enough. Although the compliance part honestly does seem a bit cumbersome, but as Vikram is saying, a lot of it has been sort of eased out for investors. But Vikram, okay, coming to you now, we just have a couple of minutes left. If I had to sort of get onto your platform, Vested, and open my account, what are the favorite stocks of Indian investors, global stocks?
Yeah, I mean, what we've seen until now is, of course, the technology giants are definitely the favorite. And as the acronym FANG goes, those are definitely favorite. But what is the most surprising bit actually for us at Vested is the number one favorite stock is actually Tesla. And by far, I think about 25% of our users have invested in Tesla. And there's something about the electric vehicle company as well as its founder, Elon Musk, that Indians have taken a liking to. But beyond that, beyond FANG, we see a lot of other technology companies that also are of interest to Indian investors. There's the likes of Shopify, Salesforce, but largely it's been technology. And then Beyond that, we see electric vehicle companies also becoming popular. And on the ETF side, a lot of metal ETFs, so gold, silver is something that a lot of investors like to invest in.
All right. So we have the list there of all the popular stocks, right? Tesla that you said, there's Shopify, there's gold ETFs. But a lot of investors still prefer the mutual fund route. And there are a lot of mutual funds that have exposure to the US markets, right? Prableen, if someone wants to take that route, what are the top 2 or 3 mutual funds that sort of you would advise?
Sonia, so for somebody who's beginning as a first-time investor and is looking at exposure to the US markets, I think a passive route is good. They can just take exposure to Nasdaq 100 or S&P 500, do an SIP or do a staggered investment through a STP route, and those are passive routes, to take exposure. The expense ratios are very less; they're just about 0.5%, hovering around that much. And for somebody who's looking to take partial exposure, then we even have funds like Bajpai, we have the DSP Value Fund, we have Access Growth Opportunity Funds, which just invest up to 35% abroad. Somebody who's just looking at exposure abroad can look at those kind of funds. And then we have these very nice funds, where a domestic fund is actually investing in a master fund abroad, which have a track record of almost 20 years, 2 or 3 decades as well. Which are actively managed mutual funds and which are only just fed by the Indian, AMC. The money is totally managed by the funds abroad. So these are different routes. So depending on their own risk appetite, what kind of time frame and what percentage exposure to the portfolio they are looking at taking, I think, they can take.
Okay, actually, you've given us a very helpful list, and I would just like to get that list up on the screen again. The list of funds that perhaps if you as an investor want to take, okay, this is the popular stocks that people invest directly into, but there are some funds as well, some mutual funds, the Parag Parikh Flexi Cap Fund, there is the ICICI fund as well, so that should just come up for you. The direct portfolios of specific sectors that you can invest into through a fund of funds. So there's the Edelweiss fund of fund as well. Is there any difference? I mean, if you had to pick one or two, you've given us many names, Prableen. There's the ICICI Pro Blue Chip Fund, there's the Nippon Fund, there's the Edelweiss Greater China Fund as well, which gives you an exposure there. What would your top 1 or 2 funds be if someone has to take exposure?
Okay, so passive route, Sonia, it would be just take an exposure to Nasdaq 100. There are 2 options by Kotak or Motilal, either of the 2, based on their own preference. And if it has to be, active exposure, then they can look at PGIM because, it's interesting because it is giving you about 65% exposure to US. It also gives you exposure to China, Europe, and Canada. So other than US, so dominant share is US, but there is also exposure to some other markets. So I think that's another good fund. But these have, really given very, very good phenomenal returns in the past, and investors must be careful with their future expectations. And I'd also like to mention, some funds in India like Parag Parikh actually even hedge 80% of their, foreign exposure with currency contract, Sonia. So it's interesting. There is a lot of variety within the mutual fund space as well to take exposure abroad.
Okay, so whether you want to go through the direct route, whether you want to take active, passive mutual funds, we've got you completely covered. Ladies and gentlemen, thank you so much for joining us. Prableen and Vikram, it was a pleasure speaking with you. We hope to chat again soon. With that, it is curtains down on another edition of Smart Money. You have a great weekend.